Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 172, recorded here on June 29th, 2025. This podcast is for entertainment only, not investing advice. Do your own homework, please. All right. Well, we are at block height 903256, Moscow time 930. Fees are 1, 1, and 1. We'll get started with the market update outlook, get into the weekly top Bitcoin news. Kind of seems to be a week of Bitcoin treasury company news, so I guess I unwittingly ended up with a few articles on that. Then we'll check out this week's featured post on the Bitcoin Fortress Substack. We'll do a look ahead. Once again, mention my new book, link in the show notes. And we will wrap it up. So, with that, let's get into the news. Wall Street on Friday posted its best week since mid-May. Yay! Moreover, the benchmark S&P 500 index notched a new intraday peak and record close for the first time since February. The Nasdaq Composite also achieved both these milestones for the first time since December last year. Everything's great. Just look at the stock market. Oh, but don't look at the dollar. The sentiment was driven by the end of a 12-day conflict between Israel and Iran. And by the way, if you think it's over, got news for you. Which drove down oil prices and tamed inflation fears. After hovering near record levels on Thursday, the final push for stocks came on Friday following the finalization of a trade agreement between the US and China, under which tariff rates will come down and rare earth exports will be expedited. Maybe we need to start making some of those ourselves. Turning to the week's economic calendar, the highlights were the third estimate of US Q1 GDP growth, which was revised lower, and a slightly hotter than expected core personal consumption expenditures price index reading. Sounds like stagflation. Also of note, Federal Reserve Chair Jerome Powell gave his semi-annual monetary policy report to Congress, where he stuck to a wait-and-see approach and did not echo Governors Michelle Bowman and Christopher Waller's recent speculation that rate cuts may come as soon as the July Fed meeting. On the earnings front, memory chipmaker Micron Technology reported solid quarterly results and guidance. The world's largest shoe company, Nike, warned of a $1 billion additional cost increase due to tariffs, but its plans to reduce its reliance on China by reallocating supply to other countries cheered investors. For the week, the S&P climbed 3.4%, the tech-heavy Nasdaq Composite surged 4.3%, and the blue chip Dow added 3.8%. Looking ahead, Wall Street's focus next week will be on Senate Republicans' push to pass President Donald Trump's sweeping One Big Beautiful Act legislation and key labor market data. Senate Republicans are planning to vote on the bill over the weekend, and Trump is hoping for its approval by July 4th, which is a stock market holiday for Independence Day. Meanwhile, the U.S. Bureau of Labor Statistics will release the June non-farm payrolls report on Thursday, a reading that could influence Federal Reserve monetary policy actions. Speaking of the Fed, Chair Jerome Powell this week said the central bank will continue to stick to a wait-and-see approach with interest rates. Powell will be speaking on July 1st at a European Central Bank forum in Portugal. The earnings calendar is light next week, but vehicle deliveries will grab the spotlight, most notably Tesla's second quarter announcement, which is expected on Wednesday. All right, moving on, let's get into the Bitcoin news of the week. We'll start with the Hodler's Digest for June 22nd through June 28th. Let's see what's up here. I'm going to skip over the shitcoinery, of course. XRP spikes 3% after Garlinghouse says Ripple dropping SEC cross appeal. Don't care about that. Crypto entrepreneur Anthony Pompliano's firm ProCap made its first Bitcoin purchase just days after revealing that it plans to go public later this year. The Bitcoin financial services firm ProCap BTC said on Tuesday that it purchased 3,724 Bitcoin for $386 million. dollars. The investment is now worth just shy of $400 million at current market prices, as the asset has gained since the buy. The firm purchased the assets at a time-weighted average price of 103,785 per Bitcoin. The buy follows the ProCap's announcement on Monday that it plans to go public via merger with the blank check company Columbus Circle Capital to become ProCap Financial. Crypto exchange Coinbase says it played a key role in supporting U.S. Secret Service investigation that resulted in the seizure of $225 million linked to crypto investment scams earlier this month. On June 18th, the Department of Justice filed to seize more than $225 million in crypto recovered by the Secret Service that was allegedly stolen by online investment scammers, which agent in charge Sean Bradstreet said at the time was the largest cryptocurrency seizure in the agency's history. Coinbase said in a blog post on Tuesday that it joined several other exchanges in an investigative sprint with the Secret Service in 2024 to identify scam victims, analyze chain flows, and help build a case to seize the crypto. Bitcoin treasury adoption by public companies has become the new altcoin season for cryptocurrency speculators, Adam Back said on Monday. I think he's got a point. Bitcoin treasury season is the new alt season for speculators, said Back, co-founder and CEO of Blockstream and the inventor of Hashcash. Time to dump alts into BTC or BTC treasuries, he added. Bitcoin treasury firms are buying BTC on repeat to increase Bitcoin per share, tapping into different funding methods such as convertible note offerings to accumulate more of the world's first cryptocurrency, making them attractive for investors, Back explained. Lawyers acting for the collapsed crypto exchange FTX have rebuked a $1.53 billion recovery claim from Three Arrows Capital's liquidators, arguing the losses resulted from a risky trading strategy that could not be paid for by creditors. Should not be paid for. 3AC liquidators initially filed a $120 million claim in FTX's bankruptcy case in June 2023 and expanded it to $1.53 billion in November 2024, alleging claims including breach of contract, fiduciary duty, and unjust enrichment. The liquidators alleged FTX held $1.53 billion in the hedge fund's assets that were liquidated to settle liabilities in 2022, contributing to 3AC's collapse, arguing the transactions were avoidable and FTX debtors had delayed providing the information that would have uncovered the liquidation. And so the sad saga continues there. Uh, Top predictions of the week. Bitcoin price registered a weekly high of 108,200 on June 25th after a 10% rise from its local low at 98,400 3 days prior. Hope you all bought the dip. Bitcoin has now reclaimed a key support level as prices continue to consolidate below the $112,000 all-time high range. Can Bitcoin price rise over 50% in the next few days? Bitcoin's rallied by 52% between April 8th and May 22nd to reach an all-time high of $112,000. Since then, Bitcoin price has oscillated between the all-time high and $100,000. The latest recovery from 6-week lows below $100,000 suggests that the bulls are aggressively defending this level. Bitcoin reclaimed the key support area, said popular pseudonymous crypto analyst Jelly in a Wednesday post on X, adding that the Bitcoin is now back inside a pennant on the daily chart. A bull pennant is a continuation pattern that occurs after a significant rise, followed by a consolidation period at the higher price end of the range. A positive breakout from the pennant could potentially lead to the next leg up for Bitcoin, measured at 165.2 or 54% from its current price level. Hackers posing as legitimate information technology workers who have infiltrated Web3 projects have stolen roughly $1 million in crypto during the past week, according to on-chain investigator and cybersecurity analyst Zach XBT. Several entities were impacted, including Saver, a Web3 fan token marketplace, non-fungible token projects Replicandi and Chainsaw, along with other teams the on-chain sleuth did not name in his Friday X post. The hackers exploited the minting mechanism for the NFT projects, minting mass quantities of NFTs, selling them, and causing the price floor to drop to zero while they extracted profit, Zach XBT said. Oh boy, stay away from the shitcoinery. Anchorage Digital is drawing criticism from at least one stablecoin issuer after announcing plans to phase out support for three stablecoins, citing regulatory expectations and internal risk assessment. Nick Van Eck, co-founder and CEO of Agora, criticized Anchorage's moves to remove support for stablecoins USDC, Agora USD, and Usual USD in a Thursday X post, claiming the decision was based on easily verifiable and known factual inaccuracies. He said that Anchorage failed to disclose its relationship with stablecoin issuer Paxos, which could potentially benefit from the phasing out of tokens issued by other platforms. Users across social media are dismayed after noticing Ledger, a major provider of hardware crypto wallets, announced last month it was sunsetting support for the Nano S. In its spring update on May 30th, Ledger said it was transitioning away from the Ledger Nano S, and as a result, new applications, feature submissions, and app updates would no longer be accepted. Another notice urging users to transition to a new device was published in April. The Nano S was launched in 2016, making some devices close to 10 years old. The wallet provider also encouraged users to check that they have their 24-word secret recovery phrase to maintain support. And that wraps up the Hodler's Digest. Moving along, this is from Bitcoin.com news. This was posted June 21st. Grant Cardone calls Bitcoin treasury companies the new gold rush. Okay, here we go. Grant Cardone, CEO of property investment firm Cardone Capital, was eager to present his plan to Michael Saylor, chairman of Bitcoin Treasury Company Strategy. Cardone knew that firms were stampeding to raise capital for Bitcoin purchases in a scenario he described as a 21st century gold rush, so his plan was ambitious but also carefully hedged with real estate, Cardone's area of expertise. It's just like the gold rush right now, Cardone told Bitcoin.com in an interview. Anytime I feel all this rush moving in, the hair on the back of my neck goes up. Gary Cardone, Grant's identical twin and a known Bitcoin advocate, had arranged the initial meeting with Saylor in January 2025. Afterwards, the Cardones wasted no time and hashed out a plan to immediately jump onto the Bitcoin treasury bandwagon, but Grant didn't want to throw all caution to the wind. I'm a very conservative investor, Cardone explained. Indeed, the plan Cardone presented to Saylor in their follow-up discussion reflected Cardone's risk aversion, a series of funds that would invest in both real estate and Bitcoin. Saylor was curious about the ratio of property to Bitcoin in Cardone's funds. I said it's 85% real estate, 15% Bitcoin, Cardone explained. By year four, though, Mike, I'm at 70-30. Cardone went on to describe how he would end up with an asset mix of 50% real estate and 50% Bitcoin around the fifth year of his strategy, which would likely include going public. But Saylor scoffed at him for being too cautious. You have a pussyfoot, Saylor told Cardone. You should start at 80% Bitcoin and 20% real estate. Cardone mulled over Saylor's comments, but decided to stick to his own conservative approach. Mike, I'm a real estate guy, Cardone explained. If I go 80% Bitcoin and 20% real estate, I'm no longer a real estate guy. Ah! Cardone says he went on to launch four Bitcoin real estate funds after his conversations with Saylor. the most recent one being the 10x Miami River Bitcoin Fund, a reference to Cardone's best-selling book, The 10x Rule. He plans on launching a total of 12 funds this year. His general investment strategy involves purchasing cash flow positive properties at a discount. The difference between the market value and purchase price is used to buy Bitcoin. The cash flow, price discount, and tax deductions for depreciation all create a flywheel effect that allows Cardone to increase his firm's Bitcoin holdings with each subsequent fund launch. There's a $4 trillion in America invested in real estate investment trusts, Cardone said. We're going to crush those because we can do maybe 12% a year. When we add Bitcoin to it, we'll go to 30 and 40% returns on a real estate portfolio. Oh, very interesting to see that happening. All right. Next up from Cointelegraph. This was updated yesterday. Few Bitcoin treasury companies will survive the death spiral, according to a VC report. Only a few Bitcoin treasury companies will stand the test of time and avoid the vicious death spiral that will impact BTC holding companies that trade close to net asset value. A business entity's total assets minus its liabilities, according to a report from venture capital firm Breed. The health of Bitcoin treasury companies hinges on their ability to command a multiple of their net asset value, or MNAV, the authors wrote. Breed's report outlined the 7 phases of a BTC treasury company's decline, which begins with a drop in Bitcoin's price that triggers a decline in MNAV, bringing a company's share price close to its actual net asset value. This in turn makes it harder for Bitcoin holding companies to secure the debt and equity financing critical to the asymmetric trade of converting the inflationary US dollar into a supply cap depreciating asset. As access to credit dries up and debt maturity looms, margin calls are triggered, forcing the firms to sell Bitcoin into the market, lowering the price of Bitcoin further, causing a consolidation of holding companies acquired by stronger firms and potentially triggering a prolonged market-wide downturn. The authors of the report wrote, ultimately, only a select few companies will sustain a lasting MNAV premium. They will earn it through strong leadership, disciplined execution, savvy marketing, and distinctive strategies that continue to grow Bitcoin per share regardless of broader market fluctuations. The death spiral could trigger the next crypto bear market. However, the authors of the report said that since most BTC treasury companies currently finance their purchases with equity rather than debt, the implosion may be contained. Equity-based financing limits the fallout in the broader market, the authors said. Despite this, the current forecast could change if debt financing overtakes equity as the more popular option. Michael Saylor's company, Strategy, has been purchasing Bitcoin since 2020 and popularized the BTC corporate treasury concept, which gained significant steam in the last 2 years. Over 250 organizations now hold Bitcoin, including corporations, government entities, exchange traded funds, pension funds, and digital asset service providers, according to Bitcoin treasuries. And they have a nice chart in here called Bitcoin Holding Firms Must Earn Their Premium, which is kind of interesting. Shows how much Bitcoin held and what their MNAV multiple is. And it looks like Strategy currently has the highest, followed by 21 Capital, and then Metaplanet, and then Similar Scientific, and then the Blockchain Group. Uh, oh, that's the size of their stack, rather. Right? The MNAV multiples highest for Metaplanet and Blockchain Group, and lowest, it's at a 1x for Similar Scientific. Strategies at 1.7, 21 Capital's at 4x. I don't know. My opinion on this is, you know, just buy Bitcoin, Why gamble with these companies? I don't know. Maybe if you really want to make, more money, go for it. If you want to try to leverage or whatever, increase your returns. But if you want to own Bitcoin, the best thing to do is just buy it, self-custody it, and sleep soundly. I thought this article was interesting. This is from Bitcoin Magazine. This is posted on June 26th. Another little take on the Bitcoin treasury. Tahini's Bitcoin treasury, how a family chain outsmarted inflation. Tahini's Restaurants, a Canadian fast casual restaurant chain specializing in Mediterranean and Middle Eastern cuisine, integrated Bitcoin into its business in 2020 and has been refining its strategy ever since. Today, Bitcoin makes up over 70% of their reserves and has made a critical difference in their expansion to 62 restaurants in just over a decade. We just kept putting more and more money into Bitcoin, Omar Hammam, CEO and co-founder of Tahini's, told Bitcoin Magazine. Omar and his brother Ali Hammam founded the company in 2012, starting with one restaurant in London, Ontario. Tahini's has since grown to 62 restaurants across the country, their expansion amplified by their adoption of an early Bitcoin treasury strategy, partially inspired by Michael Saylor in 2020. The bold move gave them a pool of capital with which they could compete with the giants of the fast casual food industry. We're competing with McDonald's and Chipotle, said Omar, adding all these companies have more money than 100 Tahinis. So to have an advantage like that, where we have a treasury and a balance sheet strategy that puts us in a comfortable place financially, that lets us preserve our wealth over time and space, it was the best decision we've ever made for our business. The company has implemented multiple innovative strategies throughout its journey, including the deployment of Bitcoin ATMs to many of their franchises. A new media strategy that, according to Ali, has netted them 3 billion views over the last 5 years across all social media platforms, including a YouTube channel with over 3.2 million subscribers, and of course, their Bitcoin treasury strategy. Ali Hammam was the main driver behind the restaurant's Bitcoin strategy, shaped by his family's experiences with the Egyptian pound's aggressive devaluations over the past 20 years. The catastrophic consequences of runaway inflation were deeply personal to him, an experience that set him up well to discover Bitcoin during the March 2020 market crash. So I came from Egypt, and over the last 2 decades, I've seen the Egyptian pound drop probably 85% or something like that. And I've seen our family struggle. I've seen my parents struggle. My parents had money sitting in Egypt over that time. I've seen their life savings get wiped away. Sometimes with Egypt, it happens like flash crashes. So the government will come in and could just devalue the currency within a month, 50%, Ali recalled. When the COVID-19 market panic happened in March of 2020, the price of Bitcoin went from a high of $10,000 to as low as $4,000 in weeks. I bought a little bit as a gimmick, and because it was just down so much, I was like, yeah, I might as well buy it. The more I studied, I fell down the rabbit hole hard. Over the next few months, I just kept buying more and more and more. And those first 3 months when you discover Bitcoin, it's just like a never ending consuming over every aspect of your life, listening to podcasts, reading books, and just buying more and more and more, Ali explained. After the crash, Bitcoin bounced back up to around $10,000, where it consolidated for months as governments throughout the world prepared their COVID-19 response and unleashed trillions of newly printed dollars into the global economy. Interest rates in the US dropped to zero, and COVID-19 support checks started to flow to anyone in Canada who filled out a form. Omar recalled that the government was just literally printing money nonstop, and it wasn't just the Canadian government, it was every single government out there that was doing it. So we knew there was going to be an inflation problem. The Bitcoin halving was also taking place right around that time, an additional fundamental force that arguably led to one of the most impressive bull runs in its history. This was the same era when Michael Saylor famously entered the industry and became the most famous Bitcoin bull to date. However, Saylor's many speeches and documents on how to structure a corporate Bitcoin strategy and how to convince the board of directors or other business partners were just starting to hit the podcast circuit, and the Bitcoin Treasury Playbook was still in its infancy. Once Ali was 100% in, he started orange pilling his family. So I started orange pilling my business partners, my brother, my cousin, and they started buying it personally. Personally, they all started buying Bitcoin in small amounts, but using the company's reserves was a far more difficult process. Ali explained that it wasn't quick. It was back and forth where I wanted us to put the company money into Bitcoin and they were kind of on the edge. That is a crazy idea, this and that. And then we just kept going back and forth until Michael Saylor announced that first buy. I'd already set up like all the accounts and all of that was just ready to go. So when Michael Saylor bought that first batch of Bitcoin, that was what pushed us over the cliff. And a week later, we put whatever money the company had into Bitcoin. Tahini's Bitcoin investment strategy differs from today's public companies, which issue stock and other financial instruments to buy Bitcoin and add to their reserves. As a private company that started accumulating Bitcoin before the ETF in the US was approved, Tahini's took a simpler approach. Buy as many as reasonably possible each month forever. According to Omar, today Bitcoin represents over 70% of the company's reserves. While their timing was excellent, having started to buy Bitcoin for their treasury at around $10,000, the strategy known as dollar cost averaging works very well regardless of price, even in a bear market. Have a look at this DCA calculation, for example, and there's a little chart down here that shows uh, the growth of a stack to 183% from November of 2021 through February of 2025. So check that out. I'll put links in the show notes to all the articles as well, so you can check it out. If you started putting $1,000 into Bitcoin every 2 weeks at the top of the 2021 bull market at nearly $70,000 per coin, every time you made a purchase at a lower price after that, you would be lowering your average purchase price. The result is that on the way out of the bear market, in this example, above roughly 30,000, you would be at break even and you would be perfectly positioned for the upcoming bull market. The only requirement is having a long-term investment mindset. You buy every month, every single month, ups and downs. I know it sounds too simple, but actually, this is the only way to do it, right? You just buy, don't try to outsmart the system. In my opinion, unless you're really good at this, put a number aside every single month and it just pans out. And if you think about it, if you look at last 4 years, you would have made more than 2 to 30x your investment, Omar explained. He added that I have this conversation with a lot of people, friends, family, everybody, and I always tell them, listen, just start somewhere. Don't put a big amount and see how it works out for you, right? So let's say you put $1,000 and watch it as a number that's not going to be too bad if anything happens to it. See, if I if let's say next year this thousand becomes 1,200 or 1,500, now imagine if you had 100,000, or imagine if you had a million, right? What would have happened to that amount? While there are no hard rules about the optimal frequency of the DCA strategy in Bitcoin, be it for individuals or corporations, Tahini's opted for monthly purchases as it made sense given their accounting processes. Every month we have a P&L. Every month we see our profit and losses, and we decide at the end of the month, okay, we're going to put this much aside, Omar explained. When it comes to amounts, Omar explained that they do not invest a fixed or percentage-based amount. It's also about, are we investing this month back in the business? Are we not? What are our expenses like? Do we have any big payments? So, sometimes you have all these expenses at the end of the year, so you have to put your month highs and lows and so on. But the key is to stay consistent in putting money in. How much is what you have to decide every month. When it comes to monetizing their Bitcoin, Tahini's has opted for the simple strategy. When the time is right and the business opportunity demands it, they sell some Bitcoin and buy it back later, as per their standard DCA strategy, and integrate the capital gains tax into their accounting flow. Omar explained that when it comes time to reinvest, you always need money. So let's say you want to do a huge marketing campaign as a franchise, right? You need to dip into those savings. And when you have money, you have power. The more money you have, the more you can be free to make the right decision for the company instead of just doing what you can afford. As one of the first steps in their Bitcoin integration, Tahini's explored the possibility of accepting Bitcoin as payment at their restaurants. However, a series of challenges arose that forced them to pivot. Many of these challenges remain for businesses throughout the world and involve the entrenched, closed source, and walled garden models of popular payment processing systems. A lot of these point of sale system companies, they do their own payment processing and they just don't have the capability to accept Bitcoin in their system. Omar explained about the world of merchant grade POS. Many of these systems are closed source with very restrictive APIs that the Bitcoin economy cannot easily integrate into, a moat that has been an issue for Bitcoin payment adoption since its inception. However, The friction to merchant adoption is deeper than just a POS moat. The feature list merchants need to stay competitive is very complex, and most Bitcoin payment systems today are still lagging behind. The POS system is not just about the payment, it's also about how they build menus in the background. The POS system gives you reports, it gives you an analysis of what you sold, when you sold it, what these stores are doing, what time of day they're busy, what time of the day they're not busy, how to ask for whatever you're ordering. It's very complicated, right? So the payment is just the last piece of the puzzle. So when we choose a POS system, it's not just about the payment system, it's also about their functionality and how good they are as a system. To top it off, POS systems that integrate Bitcoin would also have to support fiat currencies for them to be viable to normal merchants today, raising the barrier to entry and competition much further. As a result, Tahini's did the next best thing. They added Bitcoin ATMs to 10 of their restaurants in partnership with Bitcoin Well, a Canadian Bitcoin ATM company, opting to take in all profits from the machines in Bitcoin and allocating it to isolated accounts for each restaurant. Though Ali reports that these ATMs were only bringing in about $250 Canadian a month since 2021, these SATS flows, as some people in the industry are calling them, add up. And with the price of Bitcoin rising, each of these restaurants now has over $40,000 of Bitcoin per corresponding restaurant, a very significant balance. Nevertheless, Omar is optimistic that these barriers will fall as interest in Bitcoin payments is stronger than ever. I think Bitcoin is really growing at a rapid pace and is being adopted now by a lot of companies, and people are learning more and more about Bitcoin, and they're becoming much more aware about Bitcoin. So I think it's just a matter of time. All right, good for them. Next up from Cointelegraph. This was posted yesterday. Bitcoin takes pressure off the US dollar, according to US President Trump. United States President Donald Trump recently touted the positive impacts of Bitcoin on the US economy, including relieving pressure from the US dollar during Friday's White House press conference. The president said that he is a fan of the crypto industry, which has grown into a sector that cannot be ignored due to geostrategic competition. Trump added, "It has become amazing. I mean, it is the jobs that it produces, and I notice more and more you pay in Bitcoin. People are saying it takes a lot of pressure off the dollar, and it's a great thing for our country." Digital asset researcher Anders X suggested that Trump's comments were a reference to the Triffin dilemma, or the conflict of interest between being the issuer of the global reserve currency, maintaining proper trade balances, and ensuring that the long-term value of the currency. As the issuer of the global reserve currency, the U.S. must run persistent trade deficits to meet the global demand for dollars so foreign countries can settle trade and use the dollar as a store of value against more rapidly depreciating local fiat currencies. This provides a short term solution to meet global liquidity demands at the cost of the long term value of the currency, as persistent trade deficits are financed through money creation, which dilutes the value of the US dollar. Trump previously floated the idea of paying off the national debt with Bitcoin, a nod to the asymmetry between the inflationary dollar and the supply capped asset. However, critics have said that even if the US Treasury owned the entire Bitcoin supply, it would still not be enough to cover the $37 trillion and growing US government debt, which will only continue to grow, eventually collapsing the value of the dollar. Macroeconomist and Bitcoin advocate Lynn Alden coined the phrase, "Nothing stops this train," a reference to the extreme likelihood that global governments will never stop printing money and destroying the future value of their national currencies. The Dollar Currency Index, DXY, a metric that tracks the strength of the US dollar against a basket of major fiat currencies, hit its lowest level in 3 years on Thursday. Declining dollar strength comes amid elevated US government bond yields, a signal of deteriorating investor confidence in the creditworthiness of the US government and the sustainability of its debt. Next up, also from Bitcoin Magazine, this was published on June 27th, how the IMF presents global Bitcoin adoption and why they do it. In recent years, the IMF has successfully pressured El Salvador to de facto drop Bitcoin as legal tender and roll back other Bitcoin policies, successfully pressured CAR's 2023 Bitcoin repeal through regional banking bodies, been responsible for the lack of follow through from Bitcoin campaign rhetoric to action from Milei in Argentina, cited serious concerns with Pakistan's Bitcoin plans, consistently framed crypto as a risk in loan negotiations. And then they have a nice little summary table here in the article. Again, you'll see it in the show notes. As we can see, the only nations that were able to resist IMF pressure were El Salvador prior to gaining an IMF loan, and Bhutan, which does not have an IMF loan. Each country with an IMF loan who has adopted or attempted to adopt Bitcoin at a nation state level has been successfully thwarted or largely thwarted by the IMF. How is it that the IMF has been so successful in preventing global nation state adoption, with the exception of Bhutan, and why do they aggressively move to prevent it? In this detailed report, we do a deep dive into each of the three nations where the IMF has successfully pushed back against Bitcoin adoption and the signs that it is likely to be successful, achieving the same result with Pakistan. In the last section of this report, we look at IMF's 5 reasons to fear Bitcoin and how Bitcoin is still thriving from a grassroots level despite top down Bitcoin abandonment or partial abandonment by various nation states. Central African Republic, when colonial money met digital hope. The Central African Republic uses the CFA franc. The CFA isn't just currency, it's a geopolitical chain backed by France and governed by the Bank of Central African States. Of its 14 member nations, the 6 Central African nations, including CAR, must still deposit 50% of foreign reserves in Paris. This control over reserves fosters economic dependency while establishing export markets for French goods at favorable terms. In 1994, for example, the CFA was devalued by half, a policy that was influenced by Western pressure, particularly from the IMF. This caused the cost of imports to leap, leading to exporters, mainly EU-based, being able to procure resources from CFA nations at half the cost. Locally, the impact was devastating, leading to wage freezes, layoffs, and widespread social unrest across CFA countries. They have a nice little map here of all those countries. When the Central African Republic announced in 2022 it was adopting Bitcoin as legal tender, BAC and its regulatory arm, COBAC, immediately voided the law, citing violations of the CMAC Treaty, the treaty which established the Economic and Monetary Community of Central Africa. This wasn't bureaucracy, it was a warning shot from the monetary gardens of La Francafrique. Why it mattered. To this day, CAR's economy relies heavily on IMF bailouts, with 1.7 billion in external debt, or 61% of GDP. Defying BAC meant risking financial isolation. The IMF moved fast. Within 2 weeks, May 4th, 2022, it publicly condemned CAR's risky experiment, citing legal contradictions with CMAC's crypto ban. The move raised major legal transparency and economic policy challenges, the IMF said, that were similar to the concerns the IMF raised about El Salvador's Bitcoin adoption, risk to financial stability, consumer protection, and fiscal liabilities. For context, none of those risks materialized in El Salvador. But their real weapon was leverage. As CAR's largest creditor, the IMF tied its new extended credit facility, a $191 million lifeline, to policy compliance. And then they have a little timeline here. Key to scuttling CAR's Bitcoin ambitions was ensuring that the Sango project, a blockchain hub initiative from the CAR government to sell e-residency and citizenship for $60K in Bitcoin, did not proceed. In July 2022, CAR launched the Sango project. It aimed to raise $2.5 billion, or 100% of GDP. It failed catastrophically. By January 2023, only $2 million, or 0.2% of target, was raised. While IMF reports cite technical obstacles with 10% internet penetration as the reason for the failure, our analysis shows a different picture. 2 factors scuttled the project: investor flight. A CAR Supreme Court ruling formally blocked the Sango project. However, on closer examination, both of these factors hint at IMF involvement. Let's take a closer look at the evidence. The IMF's role in this investor flight is circumstantial but compelling. On May 4th, 2022, the IMF expressed concerns about CAR's Bitcoin adoption, stating it raised major legal transparency and economic policy challenges. This statement, made before the Sango project launch, highlighted risks to financial stability and regional economic integration, potentially deterring investors. Further, in July 2022, during a staff visit for the Staff Monitored Program Review, the IMF noted economic downturns due to rising food and fuel prices, which could have compounded investor caution. Reports also mentioned that the IMF and COBAC warned of inherent risks in CAR's crypto move, adding to the skepticism. The timing of these IMF statements aligns with the observed investor flight, suggesting that their cautionary stance may have influenced perceptions. While circumstantial, the sequence of events suggests IMF influence as a respected financial institution in the investor community likely played a role in investor flight. On the surface, the Supreme Court ruling looks like an independent event until we dig beneath the surface and find big question marks over the independence of CAR's judiciary, a country that itself ranks 149 out of 180 on its Corruption Perception Index, which is extremely low. As mentioned, 1 week after CAR announced its Bitcoin strategy, the IMF reported concerns, including risks to financial stability, transparency, anti money laundering efforts, and challenges in managing macroeconomic policies due to the volatility. On 29th August 2022, 117 days later, the Supreme Court of CAR ruled that the Sango project was illegal. For context, the Supreme Court, which forms part of CAR's judiciary, is described by international transparency bodies as gone integrity, as one of the most corrupt institutions in the country, with evidence pointing to inefficiency, political interference, and likely influence from bribes or political pressure. The Sango project's collapse became the IMF's Exhibit A, proof Bitcoin can't work in fragile economies, but the reality was the IMF's consistent expression of concerns created the environment where the project was structurally undermined in advance so that this conclusion became possible. 5,200 miles away in the small nation of Bhutan, we see the stark contrast of the successful Bitcoin rollout that was possible without IMF's involvement. CAR's reversal wasn't about Bitcoin's viability, it was about raw power. The IMF weaponized regional banking unions, CMAC, starved CAR of capital, and leveraged a $191 million loan to extinguish the threat of financial sovereignty. When the Sango project struggled, the trap snapped shut. Yet this defeat reveals Bitcoin's enduring power. Notice what the IMF didn't destroy. Nigeria's Bitcoin remittances still bypass dollar corridors, saving millions in fees. Kenya's BTC powered trade flourishes without IMF approval. El Salvador keeps stacking BTC despite 221 mentions of Bitcoin in loan conditions. The pattern is clear. Where grassroots adoption takes root, Bitcoin survives. But for countries announcing top down Bitcoin manifestos who have large IMF loans, all four have met with crushing levels of resistance: El Salvador, CAR, Argentina, and now Pakistan. CAR's outstanding 115.1 million IMF loan balance made it vulnerable to heavy IMF pressure. In nations without IMF loans, such as Bhutan, Bitcoin slips through the IMF's grip. Every peer to peer payment, every Lightning transaction erodes the old system's foundations. The IMF won the CAR round, but the global fight for financial sovereignty is just beginning. Argentina's $45 billion Bitcoin adoption roadblock. If CAR was thwarted in its Bitcoin plans, Argentina never made it to the start line. Pre-campaign rhetoric from President Milei suggested big things were in store for Bitcoin, yet nothing materialized. Was this just a politician's rhetoric fizzling out post-election, or was it something else at play? This section pulls back the lid on what really happened to Argentina's aborted Bitcoin aspirations. Understanding how Bitcoin adoption is going is like assessing whether a rocket is going to reach escape velocity. We must look at both the thrust and the drag factors. I'm an optimist. I believe Bitcoin will win. It is so clearly a better solution to the broken money legacy system we currently have, but I'm also a realist. I think most people underestimate the strength of entrenched forces which oppose Bitcoin. When I was running my tech company, we encountered the same thing. Our technology was 10x better, faster, and more cost effective than the legacy system we eventually replaced, but they didn't relinquish their incumbent monopoly easily. When libertarian Javier Milei was elected Argentina's president in November 2023, many Bitcoin advocates cheered. Here was a leader who called central bankers scammers, vowed to abolish Argentina's central bank, the BCRA, and praised Bitcoin as the natural reaction against central bank scammers. The case became a litmus test for whether Bitcoin could gain mainstream acceptance through government adoption rather than grassroots growth. Yet, 18 months into his presidency, Milei's Bitcoin vision remains unfulfilled. The reason? A $45 billion leash held by the International Monetary Fund. The constraints had already been put in place by the time of Milei's election. On 3rd March 2022, Argentina's previous government signed a $45 billion IMF bailout agreement. In the weeks following, details emerged that the agreement had contained an unusual clause, a requirement to discourage cryptocurrency use. This wasn't a suggestion, it was a loan condition documented in the IMF's letter of intent, citing concerns about financial disintermediation. The immediate effect: Argentina's central bank banned financial institutions from crypto transactions, BCRA Communication A 7506, May 2022. The policy remains enforced under Milei despite his pro-Bitcoin rhetoric. After taking office, Milei slashed inflation from 25% monthly to under 5%, lifted currency controls, that was back in May, the currency controls was in April, and then secured a new $20 billion IMF deal in April of 2025. But his manifesto's flagship proposals, Bitcoin adoption and abolition of BCRA, are conspicuously absent. The math explains why. Argentina owes the IMF more than any other nation, giving the fund unparalleled leverage. And I have a little chart in here in the article. Yet there's irony in Argentina's case. While the IMF blocks official Bitcoin adoption, Argentinians are embracing Bitcoin anyway. Cryptocurrency ownership grew by 116.5% between 2023 and 2024 in South America. Across the region, Argentina has the highest ownership rates at 18.9%, a figure almost three times the global average, and which has surged as citizens hedge against high annual inflation of 47.3% as of April 2025, a quiet rebellion the IMF can't control. All eyes are on the October 2025 midterm elections. If Milei gains legislative support, he may test the IMF's red lines, but for now, the lesson is clear. When nations borrow from the IMF, their monetary sovereignty comes with strings attached. And the key takeaways: the IMF's 2022 ban explicitly tied Argentina's bailout to anti-crypto policies. Milei has prioritized economic stabilization over Bitcoin advocacy to maintain IMF support. Parallels exist in El Salvador, CAR, and now Pakistan, revealing a consistent IMF playbook. Argentinians are circumventing restrictions through grassroots Bitcoin adoption. And El Salvador, a partial IMF victory. When El Salvador made Bitcoin legal tender in 2021, it wasn't just adopting a cryptocurrency, it was declaring financial independence. President Nayib Bukele framed it as a rebellion against dollar dominance and a lifeline for the unbanked. 3 years later, that rebellion hit a $1.4 billion roadblock, the IMF. To secure its 2024 loan, El Salvador agreed to dismantle key pillars of its Bitcoin policy. The conditions reveal a systematic unwinding. Number one, voluntary acceptance only. Businesses are no longer required to accept Bitcoin. 2021 mandate repealed. Public sector ban. Government entities prohibited from Bitcoin transactions or debt issuance. This includes bans on tokenized instruments tied to Bitcoin. Number three, Bitcoin accumulation freeze. All government purchases halted. 6,000 plus Bitcoin reserve now frozen. Full audit of holdings. Chivo Wallet Bitcoin office by March 2025. Four, trust fund liquidation. Bidet Bitcoin conversion fund to be dissolved with audited transparency. Five, Chivo wallet phase out. The $30 incentive program winds down after surveys showed most users traded Bitcoin for US dollars. And number six, tax payment rollback. US dollar becomes the sole option for taxes, eliminating Bitcoin's utility as sovereign payment. El Salvador's compliance makes fiscal sense. The loan stabilizes debt, 84% of GDP as bond payments loom. Dollarization remains intact. US dollar is still primary currency. Yet the backtrack is striking given Bukele's 2021 rhetoric. The Chivo wallet's low uptake likely made concessions easier. The IMF hasn't killed Bitcoin in El Salvador, just official adoption. Grassroots use persists. Bitcoin Beach, local circular economy, still operates, in fact, thrives. Tourism draws increasing numbers of Bitcoin enthusiasts, but without state support, Bitcoin's role potentially shrinks to a niche tool rather than a monetary revolution, at least in the short term. Two scenarios emerge in the future. Slow fade, Bitcoin becomes a tourist curiosity as IMF conditions take full effect. Or two, shadow revival, private sector keeps it alive despite government retreat. One thing's clear, when IMF writes the checks, it also writes the rules. Some key takeaways: IMF loan forced El Salvador to reverse six key Bitcoin policies. Precedent set for other nations seeking IMF support, and grassroots Bitcoin use may outlast government involvement. El Salvador made a lot of Bitcoin concessions. While arguably this doesn't hurt El Salvador much, it sends a strong message to the other LATAM nations such as Ecuador and Guatemala, who were watching El Salvador and thinking of copying their playbook until they checked the size of the IMF loan they had. So on net balance, it was a partial IMF win, a partial El Salvador win. And number four, Bhutan, the IMF free success story. We are now 2 years into Bhutan's Bitcoin experiment. That means we now have some good data on how it has affected the economy. The IMF warned that nations embracing Bitcoin would destabilize their economy, be less effective in attracting foreign direct investment, and endanger their decarbonizing and environmental initiatives. It specifically voiced concerns over Bhutan's lack of transparency with crypto adoption. But what does the data say? The Bitcoin reserves have directly addressed pressing fiscal needs. In June 2023, Bhutan allocated 72 million from its holdings to finance a 50% salary increase for civil servants. Bhutan was able to use Bitcoin reserves to avert a crisis as foreign currency reserves dwindled to $689 million. Prime Minister Shering Tobgai, in an interview, said that the Bitcoin also supports free healthcare and environmental projects. Topguy also said their Bitcoin reserves helped in stabilizing the nation's $3.5 billion economy. Independent analysts have now said that this model could attract foreign investment, particularly for nations with untapped renewable resources. Considering how the IMF analysis was not just wrong, but roughly 180 degrees off target, it begs the question, were the IMF's predictions ever based on data? 5 reasons the IMF may fear Bitcoin. Get all your friends, libertarians, Democrats, Republicans, get everyone to buy Bitcoin, and then it becomes democratized, encouraged John Perkins, Bitcoin 2025. What is the IMF's greatest fear? What if the IMF's greatest fear isn't inflation, but Bitcoin? And can Bitcoin break the IMF World Bank debt grip? During my recent conversation with John Perkins, Confessions of an Economic Hitman, something clicked. Alex Gladstein previously and brutally exposed how IMF structural adjustments did not eliminate poverty, but in fact enriched creditor nations. Perkins layered this with his own first-hand accounts. Perkins laid bare to me how the global south is trapped in a cycle of debt, one designed to keep wealth flowing west. But here's a twist: Bitcoin is already dismantling the playbook in 5 key ways. Number one, reducing remittance costs to loosen the debt noose. Chris Collins' sculpture symbolically captures the debt noose. Remittances, money sent home by migrant workers, often make up a significant part of developing nations' GDP. Traditional intermediaries such as Western Union charge fees as high as 5 to 10%. This acts as a hidden tax that drains foreign reserves. For countries like El Salvador or Nigeria, every remittance dollar that doesn't flow into the country is a dollar their central bank must store to stabilize their currencies. Often the store of US dollars is provided by the IMF. Bitcoin changes the game. With Lightning, fees drop to almost zero and transactions settle in seconds. In 2021, El Salvador's President Bukele optimistically predicted that Bitcoin could save 400 million in remittance payments. The reality is, has been that there's little evidence remittance payments using Bitcoin have reached anywhere near that threshold. However, the potential is clear. More remittances in Bitcoin leads to higher dollar reserves, which leads to less need for IMF loans. Little wonder the IMF mentioned Bitcoin 221 times in their 2025 loan conditions for El Salvador. They'd like to remain a relevant lender. Bitcoin isn't just cheaper for remittances, it bypasses the dollar system entirely. In Nigeria, where the naira struggles, families now hold Bitcoin as a harder asset than local currency. No need for central banks to burn through dollar reserves, no desperate IMF bailouts. The numbers speak for themselves. Pakistan loses $1.8 billion yearly on remittance fees. Bitcoin could save most of that. El Salvador already saves 4 million plus annually with just 1.1% Bitcoin remittance adoption. Adoption isn't universal yet. Only 12% of Salvadorans use Bitcoin regularly, while over 5% of Nigeria's remittances flow through crypto. But the trend is clear. Every Bitcoin transfer weakens the debt dependency cycle. The IMF sees the threat. The question is, how fast will this silent revolution spread? Evading sanctions and trade barriers. Oil-rich Iran, Venezuela, and Russia have had restricted U.S. dollar access due to U.S. sanctions in 1979, 2017, and 2022, respectively, resulting in the export of vastly fewer barrels per day of oil in each case. Whether we agree with the ideologies of these nations or not, Bitcoin breaks this cycle. Iran already evades sanctions by using Bitcoin as a way to effectively export oil, whereas Venezuela has used Bitcoin to pay for imports, evading sanctions. Iran is also able to bypass sanctions by monetizing its energy exports through mining. This avoids the IMF's reform for cash ultimatums while keeping economies running. The petrodollar's grip weakens as Russia and Iran pioneer Bitcoin oil deals. Another nation that has used Bitcoin to avoid the economic hardship caused by sanctions is Afghanistan, where humanitarian aid flows through using Bitcoin. NGOs like Code to Inspire bypassed Taliban banking freezes, and Digital Citizen Fund have used Bitcoin to deliver aid post-Taliban takeover, preventing families from starving. Afghanistan's Code to Inspire NGO uses Bitcoin donations, which can't be intercepted by the Taliban, to train women to write software. Though Bitcoin's share of sanctioned trade is small, under 2% for Iran and Venezuela's oil exports, the trend is growing. Sanctions are a critical tool for geopolitical leverage, often supported by the IMF and World Bank through their alignment with major economies like the US. Sanctioned nations using Bitcoin reduces IMF control over financial flows while simultaneously threatening US dollar dominance. Using Bitcoin as a nation state inflation shield. When nations like Argentina face hyperinflation, they borrow US dollars from the IMF to bolster currency reserves and stabilize their currency, only to face austerity or the enforced sale of strategic assets at a low price when repayments falter. Bitcoin offers a way out by acting as a global, non inflatable currency that operates independently of government oversight and which appreciates in value. El Salvador's experiment shows how Bitcoin can reduce dollar dependency. By holding Bitcoin, nations can hedge against currency collapse without IMF loans. If Argentina had allocated just 1% of its reserves to Bitcoin in 2018, it could have offset the peso's 90% plus devaluation that year, sidestepping an IMF bailout. Bitcoin's neutrality also means no single entity can impose conditions, unlike IMF loans that demand privatization or unpopular reforms. Bitcoin doesn't have debt leverage or a long history of the IMF to draw on when encouraging adoption. However, due to the Lindy effect, and there's a chart down below that shows that, each passing year, Bitcoin becomes a more viable alternative. In other words, the longer something's been successful, the more likely it's to continue to be successful. Number four, Bitcoin mining, turning energy into debt-free wealth. Many developing nations are energy rich but debt poor, trapped by IMF loans for infrastructure like dams or power plants. These loans demand cheap energy exports or resource concessions when defaults hit. Bitcoin mining flips this script by turning stranded energy like flared gas or overflow hydro into liquid wealth without middlemen or transport costs. Paraguay is earning $50 million yearly from hydropowered mining, covering 5% of its trade deficit. Ethiopia made $55 million in 10 months. Bhutan's the standout with 1.1 billion in Bitcoin, 36% of its 3.02 billion GDP. Its hydropowered mining could produce $1.25 billion annually by mid 2025, servicing its $403 million World Bank and $527 million ADV debts without austerity or privatization. Unlike IMF loans, mined Bitcoin appreciates in value and can be used as collateral for non IMF borrowing. This model, monetizing energy without surrendering assets, scares the IMF as it cuts their leverage over the energy sector. And number five, grassroots Bitcoin economies, power from the ground up. Bitcoin is not just for nations, it's for communities. Places like El Salvador's Bitcoin Beach or South Africa's Bitcoin Ekasi, locals already use Bitcoin for daily transactions, savings, and community projects like schools or clinics. These circular economies, often sparked by philanthropy, aim for self-sufficiency. In Argentina, where inflation often tops 100%, 21% of people used crypto. By 2021, to protect wealth, if scaled up, these models could reduce reliance on national debt funded programs, which is, of course, the last thing the IMF wants. By fostering local resilience, IMF Bitcoin undermines the IMF's crisis leverage. Thriving communities don't need bailouts, so the IMF can't demand privatization in exchange for loans. In Africa, projects like Gridless Energy, which has already brought 28,000 rural Africans out of energy poverty using renewable microgrids tied to Bitcoin mining, cut the need for IMF-backed mega projects. If thousands of towns adopt this, dollar shortages would matter less, and trade could bypass USD systems. While the IMF occasionally engages in spreading misinformation about Bitcoin energy consumption and environmental impact as a way to obstruct adoption, its preferred and much more powerful tool is simply to use the financial leverage it has over IMF indebted nations to strongly encourage compliance with its Bitcoinless vision of the future. The IMF fought Bitcoin adoption in El Salvador, CAR, and Argentina, and now they're fighting Pakistan's intention to mine Bitcoin as a nation state. Scaling these grassroots efforts is likely to force the IMF's hand to crack down more and more transparently. Grassroots Bitcoin economies empower communities to thrive without IMF bailouts, and people power is needed to find new innovative ways to overcome the IMF's counterpunch. And that was a post from Daniel Batten. Really, really well done, and learned a lot here about just how bad the IMF and the World Bank are. Very, very bad. The new colonialism is debt enslavement, and it doesn't just work on countries, it works on people too that live in the country that are enslaved by mortgages and car loans and student loans and credit card debt, and just keeps you on the little treadmill uh, running as fast as you can. Bitcoin fixes that. All right, moving on to Crypto Potato. This was posted on June 28th. Forget 1%, 3%, or 5%. Financial advisor recommends up to 40% Bitcoin allocation. What? Let's read about this. Bitcoin's evolution has been quite spectacular, especially in terms of global adoption. Recall that the asset was mostly ignored by legacy investors for its initial years, then became the laughing stock of many before it finally started to capture the attention of previous doubters. As prominent names like Paul Tudor Jones, Kevin O'Leary, or even former critic Ray Dalio started to enter the ecosystem, their general advice was that people should look to invest no more than 5% in the cryptocurrency. However, the adoption curve has completed a 180-degree turn, and some financial advisors are now recommending bigger percentages, a lot bigger. As reported by CNBC, Eric Edelman, head of Digital Assets Council of Financial Advisors, noted that a lot has changed since his initial take on the matter, which was 4 years ago. At the time, he advised investors, especially the more conservative ones, to allocate around 1% of their portfolios to Bitcoin. Today, I'm saying 40%. That's astonishing. No one has ever said such a thing, he said now. The reason for this monumental increase in his recommendation is the global status of Bitcoin and some other cryptocurrencies. Most were ridiculed several years ago when it was unknown whether countries such as China or even the US might move to ban them in some form. Now the situation is entirely different, as the US and a few others have presented plans on how to accumulate Bitcoin as a reserve asset. One of the most popular theories for investing is allocating 60% of a portfolio into stocks and 40% into bonds. While this classic split may have worked in the past, the landscape is different now, and it requires more risk and a greater exposure to stocks, according to Edelman. If you're a financial advisor and you had a 30-year-old client who was saving for their long-term future, you would tell them to put 100% of their money in stocks because they have 50 years to go. Today's 60-year-old is kind of like yesterday's 30-year-old. You need to get better returns than you get from bonds, and you need to hold equities longer than ever before. Instead of such solid exposure to stocks, though, he said people should diversify with crypto and Bitcoin in particular, which is a wonderful way to improve modern portfolio theory statistics. The crypto asset class offers the opportunity for higher returns than you're likely to get in virtually any other asset class, Edelman concluded. So, financial advisors getting on board, that's good for adoption. Next up from Decrypt. This was posted on June 28th. How much Bitcoin has Iran mined? It's complicated. Iran has been mining and trading in cryptocurrencies out of necessity due to major global sanctions and a local currency that has dwindled in value due to severe inflation since at least 2019. However, experts told Decrypt it's still nearly impossible to estimate its holdings. The University of Cambridge's Center for Alternative Finance estimated that the nation accounted for 7.5% of Bitcoin's hash rate in March 2021, a figure that fell as low as just 0.12% in January of 2022. Throughout its history, Andrew Scott Easton, founder and CEO of Bitcoin Miner Fund Masterminded, estimated that the country has mined approximately 60,000 Bitcoin, which would be worth $6.4 billion at current prices. Meanwhile, Kent Halliburton, co-founder and CEO of mining platform SAS Mining, estimated since 2018 the country has mined between 100,000 and 200,000 Bitcoin. That could mean its holdings are worth between 10.7 billion and 21.4 billion dollars. The timing is significant, as in 2019, Iran started issuing legal permits for crypto mining. But Rajat Alawat, researcher at compliance firm Crystal Intelligence, told Decrypt it's too complex to estimate. He said that that's because Iran's mining industry has largely been driven underground in attempts to avoid high electricity prices. The most easily traced sector is that of legally licensed crypto mining farms. In 2020, approximately 1,000 crypto mining farm licenses were issued, according to the National Council of Resistance of Iran, a coalition that opposes the current government in Iran. The same source said that in 2022, more than 10,000 licenses were handed out to miners and exchanges. However, former President Hassan Rouhani has said himself that about 85% of mining in Iran was unlicensed as of 2021. Iran's state electricity company, Tavanir, estimated that approximately 700,000 illegal mining rigs were operating in Iran earlier this year. That is because licensed mining firms often struggle to flip a sizable profit, Alawat says, due to the high tariffs and electricity prices imposed upon them. Let's say the iron and steel industry, they use a lot of electricity for melting and stuff, but the tariffs that the iron and steel industry pays are lower than what crypto miners pay, Alawat told Decrypt, explaining why so much mining goes underground. When a new Bitcoin is mined, there is no on-chain trace of where the miner was located. That means that it's impossible to know where it has come from, which allows Iranian citizens and the government to avoid international sanctions. As a result, a condition of the crypto mining license is that any mined Bitcoin must be sold directly to Iran's central bank so the government can benefit from avoiding sanctions. However, this means that individual miners and groups lose out on this benefit of Bitcoin mining. As such, a lot of the mining in Iran comes from individuals and inside institutions like schools and mosques, which have access to free or heavily subsidized electricity. Alawat explained that's not to mention government linked organizations that mine Bitcoin and also benefit from reduced electricity fees. These illegal operations put the Iranian electricity grid under immense pressure, causing nationwide power outages at times, while also skimming potential profits from the electricity providers. It has become such a large issue that Tavernier started offering bounties for those who reported unlawful crypto farms. Due to crypto mining's thirst for electricity and reports from local media, Alawat believes most of Iran's farming could be found in its major cities. In 2022, for example, the Iranian police discovered and confiscated 9,404 illegal crypto mining devices in Tehran over 6 months. On Sunday, the United States bombed Iran's Fordow nuclear site, which is buried deep in a mountain. From the day before the strike to Tuesday, according to BitInfo charts, the Bitcoin hash rate dropped 27.9%. This led to a post on X going viral with speculation that Iran was mining Bitcoin in the mountains. Alawat believes the nuclear facility would have the electrical infrastructure to operate a farm, but added there's no specific evidence suggesting there's a mining farm specifically at Fordow. Meanwhile, Bitcoin mining firm Bloxbridge Consulting pushed back against the theory in a newsletter, claiming that the industry shouldn't look too closely at short-term hash rate figures due to how volatile it is as a daily metric. Although Alawat said if the nuclear facility were to be mining Bitcoin, it would be at the hands of the Iranian government or one of its arms. The Islamic Revolutionary Guard Corps, aka the IRGC, is believed to be a big player in Iranian crypto mining, both Easton and Alawat said. The IRGC is a powerful branch of Iran's armed forces, created after the Iranian Revolution in 1979. Easton believes that the IRGC is likely the largest Bitcoin miner in Iran, citing an article by the National Council of Resistance of Iran. Again, we don't have the exact numbers, Alawat added, since the government is involved. Iran has an excellent history of hiding things, so any mining done by the government is all hidden. That's why we don't have any insights into it. Put simply, we don't know for sure how much Bitcoin that Iran has mined. That's because an estimated 85% of the industry has been driven underground as a way to avoid high electricity bills and the desire to hold their crypto tokens. It's easy to cast judgment on Iran's mining industry, but there's a large portion of the Iranian civilian population that is just mining crypto as a way to make some money and avoid the nation's hyperinflation. Decrypt found one social media account selling soundproof boxes for at-home miners with 166,000 followers, 0.18% of the entire Iranian population. Iran's general public is so into crypto that last year Iranian officials warned against playing the Telegram tap to earn game Hamster Combat. Admiral Habibullah Sayari, the deputy chief of Iran's military, said it was a distraction created by the enemy to distract from the nation's politics and called it the West's soft war on Iran. Despite the warning, citizens tapped away at the clicker game that promised an airdrop of crypto tokens for in-game progression. The game attracted over 300 million players, all hoping to get rich from the Telegram mini app. However, many players complained that once they received their tokens, claiming they got nothing but dust due to its low value. HMSTR is now down 90% from its all-time high, which it reached shortly after launch. If any Iranians held on to their hamster tokens, hoping to avoid Iran's inflation rate of approximately 38%, they'd have failed. Well, that's because it's a shitcoin. But anyway, I thought this was quite interesting since Iran's been in the news a lot lately. All right. Next, wanted to highlight this week's featured post on Bitcoin Fortress Substack. Articles entitled When Liberty Worked, Real World Case Studies in Freedom and Prosperity. From Frontier America to post-Soviet Estonia, these historical moments reveal what happens when free people build free markets with all the successes and contradictions along the way. Looking ahead at the Bitcoin Fortress Substack to see what we have coming up. Next up is Are We Near the Edge? Uh, Talking about monetary collapse. How imminent is it? Next up is a series called starting with For the Kids, really talking about teaching Bitcoin to your kids, and then, or actually, why we Bitcoin for the kids. And then the next one is about teaching kids about money in a Bitcoin world. And the last one in the series is Bitcoin and family governance structures. And that'll be followed by California wants your dormant Bitcoin, unless you hold your own keys, and then crypto qualified mortgages. Did want to mention my new book. It's good for orange pilling. It's available on Amazon. I'll put a link in the show notes for that. And with that, I will thank you all for listening to the podcast. If you enjoyed the show, please like and leave a comment. Also, don't forget to subscribe on your favorite podcast app so you don't miss an episode. You can also follow my Substack. It's at bitcoinfortress.substack.com. And you can follow me on Nostr. My NPub is in the show notes. And with that, I will talk to y'all next week. Bye bye.